Yo, you might actually be losing money by just leaving it in the bank. No cap. Don't worry, I'm not telling you to run to the ATM. Just stick around and we'll draw the whole system, deposits, loans, interest, fees, and the safety nets, and then I'll show you exactly how that setup can quietly cost you. All right, let's sketch it out. It's Ann Lee. Final talks. Finance drawn simple. All right, picture a bank like a big two-column ledger. Assets on the left, liabilities on the right. Liabilities are what the bank owes. That's your checking, savings, or CDS. Assets are what the bank owns or is owed, things like mortgages, car loans, or government bonds. The bank's whole job is to turn those assets and liabilities into profit while keeping a safety cushion for bad days. For example, if you put $1,000 into a savings account, that $1,000 shows up on the liabilities side, the bank owes it to you. The bank doesn't lock that bill in a vault under a sign that says Ann Lee's money. It pools deposits together and uses some of that cash to make loans. So that same pool might fund your neighbor's mortgage. They borrow $200,000 to buy a house, pay monthly, and that mortgage is an asset for the bank because the bank earns interest from it. Another example, banks also buy bonds like U.S. Treasury bonds, which are safer assets that pay interest over time. Or they lend to small businesses through commercial loans. On the liability side, not everything is a simple savings account. Some money comes as short-term borrowings, like when a bank borrows overnight from other banks, or certificates of deposit, or CDs, where customers agree to leave money for a fixed term. And under all that is equity, the shareholders' money and retained profits that act as a cushion if some loans go bad. Here's the bank's core trick. They intermediate. You deposit cash, the bank pools it, and lends it out. They pay savers a tiny rate and charge borrowers a higher one. And that spread is the main profit. Quick example, you put $5,000 in savings and get 0.5%. It's about $25 a year. The bank uses pooled money to fund loans, a mortgage at 4%, a small business loan at 7%, and credit card balances at approximately 20%. Those higher rates bring in way more interest than what the bank pays savers, and that gap pays the bank's bills and profits. Banks also diversify across many loans and do maturity transformation, short-term deposits versus long-term loans. That's profitable, but it creates two big vulnerabilities. One, banks sometimes invest in riskier or long-duration assets like junk bonds, mortgage-backed securities, trading positions, long-term government bonds to boost returns. When markets move, say rates spike, those assets can lose value fast. 2. Liquidity mismatch. Deposits are often withdrawable on demand, but loans and many securities aren't. If lots of customers withdraw at once, the bank may not have cash. That forces it to sell assets quickly, sometimes at a loss, or borrow expensively. Losses shrink equity and shake confidence, and that's how some otherwise profitable banks fail. Bottom line, the deposit-to-loan spread is the profit engine, but risky investments and lack of cash for withdrawals can flip profit into panic. Next up, how small reserves let banks lend big and why that matters. All right, now let's draw one of the wildest parts of how banking works, the fractional reserve system. Here's the deal. Banks don't keep all your money sitting in a vault. They only hold a small slice, called a reserve, and lend out the rest to make more loans. Say you deposit $1,000. The bank might keep 10% or $100 as reserves, just in case you or someone else wants cash. The other $900, they lend it out. Now the person who borrows that $900 spends it, maybe buying a used car, and the seller takes that same $900 and deposits it into their own bank account. That's right, that second bank now keeps 10% in reserve, lends out the rest again, and the cycle repeats. Each round creates a new deposit somewhere in the system. If you do the math, with a 10% reserve ratio, the theoretical money multiplier is 1 divided by 0.10, which equals 10. That means your original $1,000 deposit could support up to $10,000 in total deposits across the whole system. Now, that's the textbook version. Real life's messier. Central banks, capital rules, and people holding cash all slow that down. But the main idea stands. Banks don't just move money around, they actually help create money through lending. All right, let's cut the fancy talk. You want to know how banks really make money? Here's the short truth. They borrow cheap, lend expensive, and scoop up the difference, plus a bunch of sneaky little fees on the side. That's the whole game. But the story's just getting good. Because behind that simple idea are huge risks, wild math, and a few secrets that can literally shake the economy. Let's draw that out. So here's where the real money's made. Every bank lives and dies by one thing, the interest spread. That's just the gap between what they pay you for your savings and what they charge someone else to borrow your money. Say you drop $1,000 into a savings account. Your bank says, "Thanks. Here's 1% interest." That's $10 a year, not bad, right? Well, the same bank takes that $1,000, lends it to someone buying a car, and charges 5%. That's $50 in interest coming in. So they pay you $10, they earn $50. They pocket the $40 in between. That $40 on $1,000 is a 4% margin. It doesn't sound like much, but when you multiply that by millions of deposits and billions in loans, it's massive. That's why the spread, even a tiny one, is everything. When rates rise or fall, banks scramble to keep that gap healthy. If the central bank hikes rates, their borrowing costs can jump before their loan income catches up. And that can crush profits. Now, banks don't just lend money. They juggle a whole mix. Mortgages, business loans, credit cards, and investments. Each one has its own rate, its own risk, and its own potential reward. So when you hear terms like net interest margin, that's the average spread across all their stuff. It's how they track whether they're winning the money game or barely surviving it. All right, so lending's the big one. But banks aren't a one-trick pony. They've got a bunch of side hustles that stack up fast. First up, fees. You know those monthly account fees or overdraft hits when you go a few bucks negative? Yup, that's income for the bank. It's small per person, but millions of accounts make it add up quickly. Then there's credit cards. Every time you swipe, the store pays a tiny fee, called an interchange fee. That fee gets split between the payment network, the processor, and your bank. And that slice is pure profit for the issuer. For some banks, cards are huge business. Next, wealth management. Think investment advice or portfolio services. They take a small cut of the assets they manage, often around 1% a year. And on the bigger end, trading and investment services. Big banks buy and sell bonds, currencies, or even whole companies' debt for clients, earning fees and spreads along the way. All those extra streams, fees, card swipes, wealth management, trading, flow into one big pot, total bank revenue. Lending is the engine, but these are the turbochargers. Okay, so what do you actually do with all this? First off, remember, banks make money from the spread. That's just the difference between what they pay you and what they charge borrowers. So, if you can, shop around for better interest rates. Seriously, a small difference adds up over time. Next, don't treat your savings account like an investment. That interest is nice, but it's not meant to grow your wealth. It's meant to keep your money safe and ready. So think of deposits for liquidity and investments for growth. Also, watch those fees. Some banks brag about low rates or fancy perks, but then sneak in maintenance fees or card charges. Always read the fine print. And finally, don't panic when you see scary headlines. Keep your emergency fund in insured accounts, and remember, deposit insurance exists for a reason. Your money's not just sitting there unprotected. So, yeah, be smart, stay calm, and make your money work for you, not the other way around. Oh, I almost forgot. Remember at the start when I said you could actually be losing money just by leaving it in the bank? Well, that's because of something bigger. Something the bank can't control. See, even if your balance goes up a little from interest, the prices of stuff you buy, food, gas, rent, even that $50 haircut are going up faster. That's inflation slowly eating your spending power. Say you got $10 interest after a year, but your needs grew $15. You actually lost, right? We'll draw the whole story in the next video, what inflation really is, where it comes from, and how you can protect your money from it. It's Ann Lee. Final Talks. Finance drawn simple. Don't forget to like, comment, and subscribe if you find my video helpful.